Hello, my name is Andrew Ward or Wardy, and today I'm talking from Arimba, which is a Awakable country. I'd like to pay my respects to the Awakable elders, the past, the present, and the emerging leaders. Today I'm going to be talking about community exits, or the third exit. And what I'm talking about here is by exit is the point at which investors, usually founders and some seed investors, or even those investors that have invested in growth of a business, have a capital event where they step away and essentially the business continues to operate. So this is what most entrepreneurs in the conventional economy are striving to prove, that they can provide an exit for their investors so that their investors one day will turn the dollar that they're putting in today into 3 or 5 or 10, or you may even have heard of unicorns providing 100 baggers, which refers to 100 times multiple of the capital upon exit. I'm one personally, though, that the chasing of unicorns is a very messy way to run a society and an economy, and believe instead in the benefit of community wealth building, which I take to mean giving stakeholders a stake and keeping and creating wealth locally, so attached to a place. What I've started to realize, though, that the pervasive myth of business that you have to get to this exit is pervasive at a community wealth building level and in the conventional economic world. And there's a sort of monkey trap that people have got themselves into. And their belief is that they need to be starting a new enterprise and investing at the ground level, and that within a period of time, the business will be well supported and there will be an exit event. The only problem with this is reality. So we're looking at companies and or cooperatives, organizations tend to die off rather quickly. And so people, professionals who invest in the early stages of businesses are so infrequently correct with their investments that they end up blowing a lot of their investments. So when they get a winner, they tend to ride that winner to not just give it a fair return based on it in isolation, but in respect to their portfolio of investments, a number of which have failed. And these investors that are used to investing in early stage businesses with high failure rates that work on the thesis that you've got to get 100x return on the one that does win to pay for all the lost bets, flows over into impact investors and ethical investors, largely because they're investing at the very early stages of a business, usually at a prototype level. Often they're hoping to be involved at maybe when there's a hardened product with product market fit, and or when that business is looking to scale. So I want to talk about a ratio, the 1:3:9 ratio. And that is that to develop a prototype is typically 1 unit, let's call it an hour or $1 invested. To take it from a prototype to a product where it's achieved product market fit is usually 3 times the investment required for the prototype. And if you're going to then get from product market fit to scale via distribution, you're typically looking at 9 times the effort, or $9 for every $1 that was required in order to get to prototype stage. So the amount of capital required to go through prototype, product and scaling, and the risk that a business won't do that because most businesses fail in the first 1 or 2 years, means the monkey trap for community wealth building is thinking that they have to get in and create new enterprises in order to give community wealth building. I would argue that it's not the only place, and that the misunderstanding amongst the economic community of our day is that there's essentially only 2 ways to do a trade sale or an IPO, 2 ways to have an exit, either via a trade sale where a business is being sold to its competitors, or via an IPO where the business is being sold to the public markets. Now, there are a lot of businesses in Australia. Thanks to the baby boomers, we have a large population of mature businesses owned by people 60 years and plus who have all got a succession plan issue. Most of those businesses will not be of a size or scale that is suitable for IPO, nor will they necessarily be attractive to other boomer business owners for trade sale. So this opens up an opportunity for the community to build community wealth building, not by investing in new businesses with a high risk profile and with a inability to show tangible assets and a big path of going from prototype to product to distribution, finally to scale. What we've got here in Australia is billions and billions of dollars of stranded capital that might never get an exit. And those founders and early investors, when faced with life's end, might be able to pass it on to family, may not be able to. And with that stranded capital, it represents an opportunity for the community. The community related to a business might be based on location, might also be the employees or the customers or the supply chain of that business. Or in some cases, it might refer to all of those stakeholders, employees, customers, supply chain, and the locals. Might be in their best interest because of the goods and services provided by that business, the employment opportunities and training opportunities for those businesses, plus the solid returns and demonstrable returns that have made that business valuable to their owners might be improved and incentivized with co-ownership. So we've got to look for enterprises that might not be able to exit via IPO or trade sale, that where co-ownership through either the employees buying in, the customers buying in, the locals buying in, or a combination of those, actively improves the value of the underlying asset. So let's look at 1 or 2 examples where we've seen in equity crowdfunding the value of co-ownership, improving the value of the overall business. Some of the first movers into rewards crowdfunding recognized that having 100 people come to my pub venue on a Friday night gave a value to the pub of whatever was sold over the bar or collected through ticket sales on the day. Some bright spark realized that by including that person on a mailing list, you would be able to advertise to those people to come back next week and spend more money over your bar, buy more tickets to see more bands. And so those pub venues with a mailing list saw a rise in their lifetime customer value and a reduction in their cost of customer acquisition, meaning that their pub business relative to a pub business that hadn't collected the emails or their mobile phone numbers of their customers meant that pub was more valuable. As time moved on, pubs realized that their network of patrons really loved the environment. And so some of them gave them the opportunity of buying a brick, buying a bar stool, getting a drink named after them through a rewards crowdfunding campaign. And the rewards that people purchased showed their loyalty and showed that they were also prepared to buy merchandise and advertise on behalf of that business, which in turn increased the lifetime customer value of that pub, reduced its cost of customer acquisition, and relative to a pub that didn't have or only had an email list, these ones with reward crowdfunding participants were valued higher. Taking it in more recent years, we've seen the likes of venues offer equity crowdfunding to their customers. Now, the argument with equity crowdfunding is that they are substantiating the value that they're prepared as a community member who uses, patronizes, buys the beers, sees the bands, the value of that to them. And in doing so, provide evidence that the customer, that they are no longer a cost of customer acquisition. They're an active advocate for their business to acquire more customers. And so you see equity crowdfunding raises have almost as much value in terms of their marketing appeal as they do to the financial contribution by people. But again, if I've got people who've bought a brick compared to people that actually own the pub or have a stake in the pub, the underlying value of the asset relative to other assets increases because the cost of customer acquisition has been lowered and the lifetime customer value has been extended. This same logic isn't just used in pub and club ventures. It's used successfully in most equity crowdfunding raises that you've heard of, be that Sheba or Food Connect or Brewdogs out of Scotland. This is, again, slightly earlier than what I'm suggesting communities can be buying mature businesses for. This is often being used to fund the growth stage. If you go back to the ratio that we discussed of 1 to prototype, 3 to product market fit, 9 to distribute, you can kind of see rewards crowdfunding and equity crowdfunding putting in the capital to go from 1 to 3 and then from 3 to 9. What we're talking about in the life cycle of a business is mainly whether it's gone through, you know, seed and hardening of a product, it's got some scale, and it's a mature business lacking a succession plan, unable to access the other exits of a trade sale or an IPO. It's at that point that the community, either of employees, can get together and say, okay, boss, I know you want to retire. You've spent 20 years investing in your community, our careers. What we would like to do is have the ability to buy out the business and take over ownership. And in doing so, you're going to lower the cost of attracting your employees, and you're going to increase their employee tenure with you. They're going to have an actual stake. Just like what we saw with equity crowdfunding, employee ownership, instead of working on the top line of revenue and working on the key levers of cost of acquisition and lifetime customer value for the customers, employees are usually after rent and sometimes before rent, the largest line item expense for any business. By reducing the cost of employment through increasing tenure, higher levels of engagement, and reducing the cost of customer acquisition because they feel and actually do have a genuine stake in the business, you're de-risking the business and giving it the best opportunity of exiting with employees involved. Customer ownership, as we described in equity crowdfunding, can also be a means of exit. There are examples in Australia, in fact, 109, I think it was, maybe even more since I last looked, community-owned pubs and post offices have transacted in Australia alone. That is where the community has recognised that the value of the business is not just in the products and services that they use, but also in the employment and infrastructure that it provides to the community. So a community, small, regional, that buys its local post office is doing so that they've still got mail and government services connected to their small community. They're not just doing it because they want to take the profits from owning the post office. They want to see the continued use of post office services. And likewise, community-owned clubs and pubs around Australia usually provide the social fabric to those communities, and that social fabric has an enduring legacy that customers are willing to pay for, not just with their patronage, but also with actual contributions to the capital and the ownership of it. So if you've got a retiring pub owner in a remote region and they're not able to sell it to the pub owner down the road or on the public market, selling to your community becomes a legitimate succession plan. Of course, you can convert a company into a cooperative. And we have seen in Australia a couple of examples of that. Manufacturing businesses, just worked with an all-female network that addresses isolation in women called the Rural Woman. And it is converting, as we speak, from a PTY Ltd company to a cooperative, enabling all the women in the network to own that Rural Woman brand and to leverage the shared infrastructure between themselves, whilst giving a dignified exit to the owner who has put in 80-hour weeks for the last 10 years and would be loath to sell that to another business coach or and have almost no opportunity to IPO a business of that size. Yet for tribes that gather around shared causes, member ownership as an exit is a really valid way for founders and initial shareholders to have an exit at a fair return. And of course, multi-stakeholder exits where you engage the employees, the local community, the customers, the supply chain, can also come together and support one another in taking over the business with an idea that each of them will continue to work if they're an employee, continue to buy if they're a customer, continue to invest and support if they're a neighbour, continue to take active governance roles if they're a member in a cooperative structure. So when you're talking about this exit, you know, in most trade sales or IPOs, you think of them as singular transactions. X company was bought by Y for Z dollars. However, dig a little deeper and you will often see that the founders have taken a mix of, or the investors upon exit have taken a mix of cash and equity, and some of that transaction is actually deferred based on an earnout and the warranties and expectations that were guaranteed on the transaction of the sale coming to fulfillment within the next 3 years or 5 years. And so even a single transaction or between a company, a group of a founder and a group of initial investors to the community as a single transaction, could it be paid out over time, could be paid out in a mix of cash and shares, and might be dependent on warranties that the outgoing party have made. Another way, particularly popular when it's unknown what the future value of a business might be with planned improvements going on, is to provide a staged buyout. And this might suit founders and private investors who want to exit over a period of years. And so this might enable the community to create the capital able to buy it in staged progression. So potentially you might have a community that buys out the existing shareholders for 20% in the first 2 years, another 20% in year 2 to year 4, another 20% in year 4 to year 6, so on and so forth, until ultimately the community has, through staged transactions and potentially staged revaluations, purchased the business from the original shareholders, providing a staged exit for those shareholders and continuity for everybody's experience. And then there is the opportunity to do transition sales. And that is where the community is essentially gifted the business and a loan is provided to the outgoing investors, and the terms of that loan's repayment are pegged to the viability of the business organization going forward, meaning that if the business performs out of its socks because you've now incentivized ownership with either single stakeholder group or multiple stakeholder groups through this transaction, and it takes off, well, then the investors can be paid out in transition quicker. And if it takes longer, then those investors might get paid out longer, but that is recognized through the transaction value of the business. So there are multiple options that allow the community to engage in direct ownership of enterprises, and that those provide a third exit for investors. They provide a de-risked investment for the community relative to building new ventures which have yet to prove product market fit, have yet to get scale and distribution, and statistically are likely to fail. And unless the community is prepared to take on the sort of venture capitalist attitude that we have to make a couple of bets and some of them aren't going to work, then they're faced with a cruel choice of seeing that some of the businesses that they put blood, sweat and tears into won't achieve product market fit, won't achieve scale, will fail, and that could put a whole taint on the idea of community wealth building. Far better, in my opinion, is to have the community buying out mature businesses via the third exit options. Thank you very much.